All right, we've used a flexible budget basically in the previous module when we were doing cost volume profit analysis. And what it basically is where you take your income statement and you organize it based on how costs behave. In other words, you take your revenues and subtract first your variable costs. Those are the costs that vary, i.e. increase as you increase your sales. And then you get what's called the contribution margin. That's your amount that will contribute to covering your fixed costs. The total fixed cost here is fixed. And once you've covered all of your fixed costs, the rest goes to operating income. So what we want to do is use this to do things not like we did before, which was ask questions like what would happen if we say bought another oven, or what if we were to buy higher quality food and hence increase our price, what would that do to operating income? So there's all kinds of those types of questions, but for budgeting purposes, what you use the flexible budget for is to see how well the company was able to control its cost, and then to use it to evaluate the performance. So in our example, we had assumed that we'd have 2,000 customers. So based on that, we can translate the sales and the variable cost on a per unit basis. So in other words, our revenues were 24,000 in total, but if we have 2,000 customers and get 24,000, that's your $12 that you make per customer. Now our variable costs were $3.60 per customer. Again, it's 30% of your sales, but in this case, 7,200 is what we had intended to incur for 2,000 customers. So for every additional customer, it will cost $3.60. Now that will give us our contribution margin per customer, and that's $8.40. So every time you have a customer, you have $8.40 that will help to contribute to covering your fixed costs. Now remember, we're not going to take our fixed costs and put them on a per unit basis because they will not they're not flexible. The total fixed cost is going to be $12,600 no matter what. So when we go to do what's called the flexible budget, let's say what happened in this example is that we ended up having not 2,000 customers as originally planned, but we had 10% more. So 10% more means we had 2,200 customers. In other words, 2,000 times 1.2, 1.1, or 110% to get 2,200. Now what does that mean in terms of what, in other words, should we have made given that we had 2,200? So what you do then is you take your 2,200 customers and multiply it by your $12. So basically what you're saying is your sales revenues should have been 26,400. What management does then is compare it to what the actual sales were, and if the sales were, let's say, 26,000, then it means you had a variance, and that means you basically had what they call an unfavorable variance of 400. In other words, you should have had revenues of 26,400, but you only had 26,000. So what you would then do is try to figure out, well, why was that? So you can do this with all of your costs. You would basically figure out what the flexible amount would be. So in other words, given that we had 2,200 customers and it's supposed to be 360 per customer, then we should have had, and let me get rid of this for a second, we should have had, ooh, sorry, I went too far. We should have had costs of 7,920. In other words, 360 times the 2,200 means that we should have had costs of 3,920. What you then do is compare to what the actual amount was, and you're hoping it's going to be a favorable variance if it's not 7,920. In other words, you hope that you didn't spend as much. But if you did end up having your actuals be greater than your budgeted amount for that level of activity, then maybe there's a good explanation. Maybe it's because you did buy higher quality foods, and maybe that would then explain why you had more customers. So a favorable and unfavorable variance would have to be investigated to see what was the cause. And then as far as the fixed costs go, you take each one and compare it to what the actual is and get your variance. And again, you'd go and look into why did it vary. Now, as far as performance evaluations, you've got to be careful that you don't, let's say, these costs like depreciation, if you're, say, evaluating your employee, if you're the one as the owner of the CEO of the company was the one who determined that's what the amount would be, likewise, say with advertising, you shouldn't evaluate that employee if that employee did not have control over the cost. In other words, you as the CEO dictated that cost. So that's important to, again, not to hold somebody responsible for something they didn't have control over. So that's the idea behind the flexible budget. It's very useful and helps for companies to maintain control over their business and hopefully be able to correct mistakes and go forward.